We'll talk now about partnership dissolution. When I was studying for the bar exam, the professor said, Big M always ends in Big D. Big M's marriage. Marriage always ends in Big D. Big D death, Big D divorce. Those are your only two options. And it's a little depressing, but the same thing is true with partnerships. They're created by agreements, and therefore they're finite. People retire, people die, people change their minds, and partnerships end. So you have to sort of think about this and what the effect of this fact is on business. First, let's take a look at what partnerships own. Partnership capital would be what has been paid in to start the business in the first place. And when the partnership generates assets, who owns them? Is it the partnership or one of the partners? These are the kinds of problems you get into with partnerships. Unless it's contrary to the partner's intent, all partnership property belongs to the partnership. Again, you have to look at what the partner's intent was. One common problem is when one of the partners paid into the partnership account. Was it a contributions? In other words, money that got the business going? Or was it simply a loan? And the test is, what was the intent of the donating partner at the time that the partnership acquired that property? And money is property. Anything you can own is property, not just real estate. Okay, factors regarding intent include anything that may have been written at the time, any partnership records, accounting records, for example, tax treatment. How did the partnership pay taxes on that piece of property? For example, if it's a truck, did the partnership pay the vehicle license fees on that asset? Did the partner depreciate it as a business loss? If so, it tends to make it look like the intent of the partners was for it to be partnership property. Look at the source of funds. How was that truck purchased? Was it purchased by one of the partners who simply permitted the business to use it? Or was it purchased with partnership funds? The first example makes it look more like it was intended to belong to the partner, while the second one makes it look more like it was intended to be a partnership asset. Look at the title. For some property, including real property, vehicles, securities, and some other things, they'll have title registered in a particular name. There's a recording of who owns the property, and so take a look at that and see if it helps determine what the party's intent was. As a cautionary note, people are always trying to avoid taxes, and therefore they sometimes treat things differently for tax purposes, simply to reduce tax liability. And it may not necessarily be conclusive about what the party's intent was. So, for example, it may be that with a partnership between Jonathan and Delia, Jonathan had a truck, and he had allowed that truck to be used for the partnership business, but he bought the truck in the first place. He has the partnership pay the truck expenses, repairs, taxes, insurance. Does that make the truck look like a partnership asset? Well, maybe, maybe not. You're looking at the partner's intent. It may be that the truck was a contribution, and that's why the partnership is paying for all those costs. Or maybe Jonathan was simply lending that truck to the partnership and was having the partnership pay the taxes, insurance, and maintenance simply as a form of reimbursing him for the cost of the loan of that vehicle. So there are no hard and fast rules in this, except that the test is what the partners intended at the time that the property was acquired for partnership use. And unfortunately, partners don't always make their intent very clear. Now, if every partnership ends in big D, dissolution, how does that occur? Dissolution occurs whenever the partners no longer agree to co-own a business for profit. How long does that take? Well, it could be a minute. Does that mean the business is over? No, 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 no. Distinguish in your mind dissolution, where you no longer agree to co-own a business for profit, as opposed to winding up. Winding up is the process of terminating a business, for example, selling off assets, collecting debts, paying creditors, anything you have to do to finish a business, that's called winding up. and the winding up could take years. Now compare a partnership at will as opposed to a partnership for a term. And recall what we talked about in employment at will as opposed to employment for a term. Employment at will continues as long as the employer and the employee will it or want it to. And as soon as they don't want it to continue, it ends. So that's the same thing with partnership at will. You're partners until you don't will it anymore. Compare that with partnership for a term, where you agree to be partners, or joint venturers for that matter, for a particular term of time. It could be a number of years. For example, we agree to be partners for 5 years. Or it could be, and this is very common with joint ventures, until the culmination of some event. For example, we're going to partner on this deal until we finish building the new sports complex downtown. So that would be a partnership or joint venture for a term, completion of the construction. You need to know the consequences of a wrongful dissolution as opposed to a non-wrongful dissolution. A non-wrongful dissolution would be whenever a partnership at will has ended because the partners are allowed to end it at will, and that's not wrongful. Partnership for a term occurs at the end of the term. So in the previous example, once we finish building the sports complex downtown, that's the end of the term. And dissolving at that point is not wrongful. Or partnership by unanimous agreement. So for example, if it's a partnership for a term and the term is not complete, but we simply all agree that we're going to terminate the partnership, that's not wrongful. There are some miscellaneous categories of things that are going to be so obvious we don't even need to mention them. They're written about in your textbook. What are the consequences of non-wrongful dissolution? Any non-wrongfully dissolving partner can demand a winding up. That means a termination of the business unless the partnership agreement sets something else up. Any non-wrongfully dissolving partner is permitted to participate in the winding up. In other words, who is it who decides which funds get paid and how they're getting paid, who assets get sold to? That's the kind of power we're talking about. Any non-wrongfully dissolving partner has a right to share in the goodwill of the company. What's goodwill? Goodwill is an intangible asset of a company. So if you subtract out what I'm going to call hard assets, although I'm sure this isn't what an accountant would call it, what's left is the value of the brand. Let's take Kentucky Fried Chicken, for example. Years and years ago, there really was a Colonel Sanders, a white-haired guy with a little black tie and a white suit. He started Kentucky Fried Chicken in Kentucky, and it got very popular, and eventually someone bought him out. It might have been Pepsi. Now, why did Pepsi bother to buy him out? Can't Pepsi just create a fried chicken franchise themselves? It can't be that hard. You and I could probably figure it out. Why buy Kentucky Fried Chicken? Why buy Colonel Sanders out? Well, because people go to Kentucky Fried Chicken instead of some other chicken place or some other fast food place. There's a value to that brand, and that's what Pepsi wanted. They wanted the logo, they wanted the picture of the Colonel, they wanted the idea of the secret spices in the recipes. That's the brand. So on a smaller level, suppose that you're running a restaurant with someone. What would be included in the goodwill? The name and other things. Think about location, a phone number, the website. All of those people may not even know when an ownership has changed hands. All they know is that the restaurant is in the same location that it's always been, and that's where they go. So this is very powerful in terms of the value of a company. Not all companies have any goodwill. But if there is some goodwill, non-wrongfully dissolving partners have a right to their share of that value. And they have a right to receive any damages if there was a wrongfully dissolving partner. They have a right for that wrongfully dissolving partner to pay them that value. What causes a wrongful dissolution? Well, it could be anything in violation of the partnership agreement. And typically, this is going to be a partnership for a term before the term's up. A court order, that's going to be pretty obvious then. What are the consequences? A wrongfully dissolving partner has no right to demand a winding up. In other words, they could be excluded and the remaining partners can continue the business without them. If there is a winding up, they don't have a right to participate in that. The non-wrongfully dissolving partners have that right. They have no right to any share of goodwill, and they're liable for any damages resulting from a breach of the partnership agreement. Let's talk about the processes of winding up. As I mentioned before, winding up means continuing the business long enough to conclude any matters that are outstanding, and this could take a while. The partners who are conducting the winding up owe fiduciary duties to all partners. There's a relationship of trust and confidence. The partner's authority during a winding up, well, they have express and implied authority for any actions reasonably necessary to finish that business. They have apparent authority based on any third party's reasonable expectations. And think about it, creditors may not even realize there's been a dissolution, so you may want to put creditors on notice that the business is being wound up so that they don't come back later and say, well, I had no idea. I assumed this was simply a continuing business. And this partner therefore had apparent authority to enter into entirely new agreements to continue some new business. Disputes during that winding up period are dissolved by a majority vote of the non-wrongfully dissolving partners. Let's talk about the settlement of partnership accounts when you're ending a business. First off, these are separate categories, and you pay off each category before you go to the next lower one. If you don't have enough money to satisfy all of the obligations on one level, you pay them off as a percentage of whatever is available. So the first in priority are outside creditors. By outside creditors, I mean not the partner creditors, but some third-party creditors. They get paid first. Second, if there is still funds available, you pay off the partners who are creditors. You may or may not have any, but if there are, they get paid next. Third, you pay off the contributions that partners have paid into the business. And fourth, if there's any money left over, that's profit, and you share it the way the partners share profits. Let's take an example. Let's suppose that Matt and David had a partnership that is being wound up. Let's suppose in 2010, Matt and David each paid in $10,000, presumably as capital contributions. So $20,000 total capital contributions. Let's suppose that the following year, Matt loans the partnership $5,000. Now let's further suppose that outside creditors are owed $10,000. What happens? Let's take two different hypotheticals. First, let's assume that the partnership has assets of only $20,000. The first in line to get paid are the outside creditors. They're owed $10,000. Now you have $10,000 left over after you pay the outside creditors. Next, you repay Matt his loan of $5,000. That leaves only $5,000, and the capital contribution, if you will recall, totaled $20,000. Matt and David each paid $10,000 for a total of $20,000, but there's only $5,000 left over. Well, tough luck. You each get 25 cents on the dollar. So you'll get $5,000 if your 50-50 partners will split it in half and each get $2,500 of the remaining. So altogether, David will get $2,500 and Matt will get $7,500 if you add in his loan repayment. Instead, assume they have a lot of money left over, $300,000. They're going to pay off $10,000 to the outside creditors. That leaves $290,000. Now they repay $5,000 to Matt, which leaves them $285,000. Next, they repay the $20,000 of capital contributions. That leaves them $265,000. assuming they split 50-50, you would divide the $265,000 in half, and they each get half of that. Now, what happens when a business continues? Any new partnership is liable for prior debts. However, if you add any new partners, the new partners are not personally liable. But the new partner should realize that the new partnership's assets can be reached by previous creditors. The original partnership is also liable for any private debts absent a novation. So, let's suppose in our hypothetical with Matt and David that they're going to dissolve, but the business is going to continue with a new partner. And let's just say that that's Annie. Now, instead of being Matt and David, it's going to be Matt and Annie who are partners together. From here on out, David would not be personally liable for any new debts incurred by the new partnership. He remains personally liable for any old partnership debts while he was a partner, unless there was a novation. And novation would be, well, let's suppose they have a lease that's 5 years, and they're only 1 year into this 5-year lease. And David would, understandably, like to get his name off the lease. If the landlord agrees to substitute out, just cross out David's name from the lease and instead substitute Annie's name in there, then great. That's a novation. It's unlikely to get the landlord to do this, however, because why would they? Why would they release David if they got him for another 4 years as a potential pocket for liability? However, if you can get them to do it, that's a novation, and it's wonderful. David might want to have an indemnification agreement. Indemnification means whenever you get one party, whenever someone agrees to reimburse you for something. So it might be that David has an indemnification agreement with Matt and Annie to reimburse him for any losses he has incurred, if he can get them to agree to do so. So outgoing partners in this hypothetical, David is not liable for any subsequent debts unless there's something called partnership by estoppel. If there is a creditor who all the way along has known that David was a partner, and let's just say that they called this business Matador as a partnership. David used to be a partner, but he's no longer a partner. Is there any way the creditors know that? Well, not if they don't tell them. So a creditor could assume that since the name didn't change, it's still called Matador's, that David remains a partner, even though in fact he's not. David could be considered a partner by estoppel, and he could remain liable. It's the same idea with an ostensible principal. You could be liable because of the expectations of reasonable third parties. So, best practice is put creditors on notice when you dissociate yourself from a business. And that concludes our discussion of dissolution of partnerships.